We've all heard the news that Jim Rickards is bullish about gold. So bullish, in fact, that he previously predicted that gold will reach a high of $15,000 by 2026. And while you still may be digesting that prediction, he's just released an updated forecast, and I know you're definitely going to want to hear this. In his words, "I've previously said that gold could reach $15,000 by 2026. Today, I'm updating that forecast." Rickards has emphasized that his latest projection is not made for attention or shock value. It's not a guess, it's the result of rigorous analysis. So, what's his latest prediction, you ask? Well, in a recent article for the Daily Reckoning, the billionaire investor and economist stated that he now forecasts that the price of gold may actually exceed $27,000. While this may sound far-fetched, Rickards puts together a strong case that is worth listening to. And with a track record of accurate predictions, including Brexit and the Trump presidency, Rickards' insights are not to be ignored. In fact, even if the gold price grows by only half of what he suggests, Rickards' prediction presents a significant opportunity for investors in an otherwise challenging market. So why is Rickards so bullish about gold? How has he determined such a dramatic price level forecast? And what can you do to make the most of this incredible opportunity? We will answer all these questions and many more, so give this video a thumbs up and let's dive in. In order to make such a sensational prediction about the price of gold, Rickards has first taken a step back into history. Prior to 1971, the US dollar was pegged to gold at a fixed rate of $35 per ounce under something called the gold standard. Tying the value of the dollar directly to gold helped ensure its value remained stable over time, increasing public confidence in the US financial system and providing a common basis for valuing different currencies. As Rickards puts it, prior to 1971, gold was money. However, the gold standard limited the government's ability to manage the economy and respond to financial crises, particularly during periods of inflation and recession. And as a result, it was abandoned by President Nixon in 1971. Breaking the link with gold gave the Federal Reserve greater flexibility and marked the transition to a fiat currency system where the value of the dollar is instead based on trust in the government's ability to manage the economy. Many economists saw this as a positive step forward, and, in Rickards' view, it took about 60 years from 1914 to 1974 to drive gold out of the monetary system. No central banker wants to let it back in. However, times may be changing. Currently, the US economy is plagued by high and persistent inflation, stagnant economic growth, and a national debt that is over 120% greater than the value of the goods and services the economy can produce. High inflation is eating away at purchasing power, and the crippling national debt is undermining confidence and devaluing the dollar. As Rickards puts it, our debt to GDP ratio is out of control. That debt overhang is the biggest single problem in the financial landscape. Given the very shaky footing the US economy currently finds itself on, Rickards suggests that a move back to relying on gold may be on the cards. In his words, what if confidence in command currencies collapses due to some combination of excessive money creation, competition from Bitcoin, extreme levels of dollar debt, a new financial crisis, war, or natural disaster? In such a case, Rickards contends that central bankers would be forced to go back to gold. Not because they want to, but because they need to in order to restore order, stability, and confidence in a monetary system that is under serious stress. But if the Fed was to return to a gold standard, at what gold price would the dollar be pegged at? In Rickards' analysis, he asserts that the policy goal is to get the price just right to avoid inflation or deflation. He has cited the UK's disastrous return to the gold standard in 1925 as a warning, as it pegged at an unrealistically low price, creating deflation and ultimately leading to the Great Depression. But if the dollar price is too high, investors will sell gold and spend freely, causing inflation. Fortunately, Rickards believes he has been able to calculate just the right price to maintain the proper equilibrium between gold and dollars. Now, without boring you to death with all the intricate details of his analysis, his key message is this: the perfect price for gold is $27,533. At this point, you may be thinking Rickards has lost his mind. But there is another body of evidence that supports his views and demonstrates that we are at the beginning of the next great gold bull market. Now, before I show you this support, please take a moment to help the channel out by hitting that subscribe button. It only takes 2 seconds, and each new subscriber is a massive help for the channel. Now, back to what I was saying. As you can see from this chart, the current price of gold is around $2,400. While it has shown impressive growth in the last 5 years, the question still begs, how can it possibly jump to $27,000? Fortunately, understanding why Rickards is so bullish about gold prices does not require a Harvard MBA. Firstly, Rickards argues that when you break it down into simple math, the increase becomes more fathomable. Let's look at the following example. If the price of gold goes from $3,000 to $4,000, that's a 50% increase. But to move from $4,000 to $5,000 is a 25% increase. And to move from $10,000 to $11,000 is only a 10% increase. And finally, to move from $26,000 to $27,000 is less than a 4% increase. As you can see, a pattern soon emerges. Each gain is $1,000 per ounce, but the percentage increase to get you there drops each time as the starting point gets higher. In Rickards' view, each $1,000 jump represents a smaller and easier percentage gain than the one before. But what will drive such a jump in the gold price? Ultimately, it comes down to a matter of simple supply and demand. Unlike paper currencies, such as the dollar, which can be printed by central banks, there is a limit to the gold reserves that exist on Earth and how much gold can be profitably mined. As this chart shows, mine production of gold in the US has been decreasing steadily since 2017. As you can see, mine production in the US was 170 metric tons in 2023, representing a 28% decrease over the last 7 years. This comes despite gold prices rising over the period and miners therefore having the motivation of rising prices to expand output. In addition, the quality of gold being mined is decreasing over time. As Rickards puts it, my contacts in the mining community consistently report that gold is becoming more difficult to source and the quality of newly discovered ore is low to medium at best. A flat or decreasing supply of gold puts a floor on gold prices, lending itself to higher prices over the long term. On the demand side, Rickards has noted that there has been increased demand for gold in recent years, driven largely by central banks, ETFs, hedge funds, and individual purchases. As this chart shows, central bank demand for gold has surged from less than 100 metric tons in 2010 to 1,100 metric tons in 2022. That's a 1,000% increase in 12 years. And central bank gold demand remained strong in 2023, ending the year just below 2022 levels, with no signs of that demand slowing in 2024. There is also high demand for gold right now from individual investors, ETFs, and hedge funds, as it is seen as a great hedge against inflation. As you may know, the Consumer Price Index, or CPI, reached a high of 9.1% in 2022, a level that has not been seen for decades in the US economy. Inflation is still not fully under control in 2024, which is where gold comes in. Gold has long been considered a safe haven asset, especially during times of high inflation. This is because it has strong preservation of value. Inflation erodes the purchasing power of currencies like the dollar, and as paper money loses value, gold becomes more attractive as a store of value. This means that gold has historically had a strong track record of being an excellent inflation hedge. During the 1970s, When the US faced high inflation, gold shone as a top inflation hedge. And when oil price shocks and energy shortages drove average annual US inflation to around 8.8% from 1973 to 1979, gold delivered an impressive 35% annual return. So let's now see how this interaction between supply and demand is impacting the current price level of gold. As gold supply is finite, it is represented by a vertical supply curve on this simple supply and demand chart. As you can see, we've assumed a fixed quantity of gold in the short term of Q. Demand is represented by the downward sloping line D1. It slopes downwards because the lower the price of gold, the higher the demand for it. As central banks are currently demanding more gold, the demand curve shifts outwards from D2. With supply fixed at Q, demand outstripping supply means the price of gold shoots up from P1 to P2. In addition, gold often exhibits low or negative correlation with traditional financial assets such as stocks and bonds. This means that its price movements tend to be independent to those of other assets, which is particularly helpful in the current climate, as many market commentators are predicting a stock market crash in the coming months. These concerns about the US economy come against a global backdrop of recession in Germany, slowing growth in China, and near-recession conditions in Japan and the UK. Rickards also points to growing geopolitical tensions, such as the war in Ukraine, as adding to the chances of economic turmoil on a global scale. As Rickards puts it, stocks are expected to perform poorly, potentially losing up to 50% if geopolitical conflicts escalate. As a result, many expect a declining stock market to fuel future growth in gold prices. And this is why so many investors have been so keen to buy the precious metal in recent months. So, how can you invest in gold to make the most of this incredible opportunity? Option 1. Buy physical gold. Buying physical gold or bullion is what most people picture when they think about investing in gold. And you can purchase physical gold from reputable dealers or mints, providing you with direct exposure to the metal. Many see this as the most exciting way to invest in gold, but it's also the most challenging. When you directly purchase gold, you will need to physically store it. Not only does it take up a lot of space, there is also a risk it can get stolen, lost, or otherwise spoiled. These are all risks that do not present themselves in other forms of gold investments. Option 2. Gold stocks. Buying gold stocks is another way to invest in gold without having to physically own and store it. Gold stocks are shares of publicly traded companies that are involved in gold production, such as miners. Depending on your attitude to risk, you could invest in junior miners which offer very high upside potential but come with higher risk. Or you could invest in more established mining companies that offer more steady, less risky returns. Just like buying any individual stock, buying stock in a gold mining company comes with some risk, but it means you have complete control over which specific companies you invest in. And while owning gold stocks won't let you hold gold in your hand, it does mean you have the benefit of an asset you can sell at any time. Top performing gold stocks in the last year include established miners, Harmony Gold and Kinross Gold, as well as junior miners such as Alamos Gold Inc. Option 3. Gold funds. A more realistic way to invest in gold is through a gold exchange traded fund. ETFs are a popular low-cost way to invest in gold without having to physically own and store it. ETFs track the price of gold and allow investors to buy shares in a pool of gold. ETFs are typically passively managed, which means they do not involve a fund manager making trades all day. As a result, management fees are typically lower on ETF products than for traditional mutual funds. You can buy and sell shares of gold ETFs through your brokerage accounts just like you would with stocks, making it accessible to a wide range of investors. And as gold ETFs are traded on major stock exchanges, you can easily buy or sell them at the prevailing market price. Some of the best performing gold ETFs right now are IAUF, the iShares Gold Strategy ETF and AAU, the Goldman Sachs Physical Gold ETF. Both ETFs have provided returns of approximately 13% in the last year alone. As Rickards puts it, the lesson for you as an investor is to buy gold now. If you want to learn more about the current state of the economy, head on over to this video where I show you just that. Thanks for watching, and until next time, keep building your wealthy life.